All right, here we go. All right.
Okay, 3, 2, and 1.
Hey, folks, welcome back to your Frederick Real Estate Update. I am Darren Ahern with Remax Results, bringing you over 22's experience in the Maryland and PA region. And on this beautiful summer day, I got the man with me from Presidential Bank Mortgage, Mr.
Terry Kernan.
How you doing, buddy?
Couldn't be better. How are you?
Actually, we are out of June. We are in July.
Can't believe that
Happy
is July.
Yep. Happy 4th of July. I hope everybody has had a good time and celebrate. Of course, we want to thank all of those who have served, are serving, and the freedom of our nation and all that we stand for. Amen. God bless America, as they say, America. All right, let's get right into it. When we get down to real estate stuff, we're going to start off with mortgages. We don't have no numbers because we've done this last week, and so we want to get a little more content, finish up what we've been working on because this is good stuff. And we want to thank all of our listeners out there. You guys are welcome to send in your questions and things. All of our information is at the end. And you can go back in the drop-down menu on WFND.com. And in the drop-down on your Frederick Real Estate Update, you will see all 416 past programs. So here we go. 8-year anniversary was last week for Terry
Absolutely.
and I. So we were celebrating also and all that good stuff.
The grade 8.
The grade 8. All right, let's get right into it as we are in the thick of the summertime now with real estate. We're going to talk about mortgages. What's going on over there?
So let's hit a couple things. Everybody wants to know about the rates, right? So the rates have been gradually coming down. There's been a lot of positive things. And part of the pressure is we look at the 10-year Treasury bond. That number has been creeping down. We're in the 4.2 range right now. And we are nearing the 8-month low for rates, okay? But as we know, anything can change it very quickly, and that number can go up. Rates can go up. So we take a look at the 10-year bond, and that is what a lot of our mortgage interest rates are based off of. Let's talk about a couple of things that aren't really the headliners, and that is last week we had the personal consumption expenditure come out, and that is the Fed's favorite marking of inflation.
All right.
And that was, as expected, up 0.1%. Now, stripping out the core rate, all that, it was up 0.2, but it's still in a reasonable range. It did kind of, slow things down with the dropping of rates because they wanted it a little bit more. But let's talk about something that they're not really headlining. Okay, let's think about, my prediction is the next time that they meet, they are going to cut rates. Now, are they going to cut them 50% or 0.5%? No, I think they're going to take a look at a 0.25% cut. The one thing that we have to realize is that when you raise rates as the Federal Reserve, or when you cut rates, it takes several months for that effect to go into place. Now, some of the Fed presidents, some of the Fed board members, they're concerned that if they don't start cutting rates now, we're going to be in an uh-oh moment like we were 4 years ago when everybody called it transitory inflation. We had to raise the rates so fast
To get ahead of it.
to catch up with our mistakes that we did in not raising the rates when we first started to see inflation. Here is something that is not the headliner. This is something that, if you follow this stuff like myself, you will see it. But let's talk about a stress test, okay?
All right.
Anybody out there listening probably knows that I've been through some heart issues, got a bypass surgery, and a stress test basically told the doctor that, things weren't working. But let's talk about what a bank stress test is.
All right.
Okay? This is very important. It's a tool used to measure whether banks have adequate capital to absorb losses.
Okay.
And what they're going to do is they're going to see about reserves. So let's say a large bank has to keep 4.5% of what they're lending in reserves. Now that 4.5% basically does not allow them to lend that money because they have to keep it in reserves. So when the crash of 2008 happened, the banks and the Federal Reserve basically said the reserves were not high enough for these banks. So we were going to raise that reserves and that's been in effect for a long time. One of the things that keep an eye on, that I'm going to keep an eye on for you, I don't want you looking this up, but we're going to keep an eye on what the Fed does in loosening the reserve requirement. What do I mean by that? Is instead of having 4.5%, maybe they determine through a bank that, hey, this bank can handle some losses. They're producing very good loans like Presidential, and we're going to allow them to, do a 2.5% reserve. So what does that mean? That's an extra 2% of their total value that they're going to be able to lend.
Okay.
So there's more money being lent out on the market, which means a higher supply of money.
Right.
Means that the price is going to come down in the money.
Mm-hmm.
Okay. So let's keep an eye on the stress test. Let's keep an eye on what's going. But that, I believe, is a factor that is going to help us lower the rates and feel more comfortable about lowering the rates, because there will be billions of dollars of extra money coming onto the market to lend. Does that mean that we're going to say, oh, we can now do interest only, no documentation, no credit report loans? No. What it means is that we don't have to be as selective in who we're lending to, because we only can lend so much. So it will ease the guidelines a bit more so more people can buy.
There we go.
Did I explain that okay?
Yeah. The stress test of banks.
Yeah. So it's something that has been talked about the last couple of weeks, and I believe that we are going to see something that will be significant here. And I believe I'm sticking to my guns that the next meeting of the Board of Governors, they are going to cut rates. I'm going to go with a 1/4 point cut, and I think they're going to be in kind of a wait and see mode. But I've said it time and time and time again, is learn from your mistake when you called it transitory inflation. They got so far behind that they had to rush to raise rates. We are looking at a GDP that is not really, those numbers aren't that great. If we have a couple, if we have a couple more quarters with the GDP decreasing, that means the economy shrinking a little bit. That means we're going into a recession. And the only thing that can help rates during a recession is to lower them.
Yeah.
The only thing that can help get us out of the recession is to lower the rates. So let's not lose our focus. But if you're out there listening today, Chairman Powell, I know we're on a first name basis, but please think about getting ahead of the rates by cutting now and bringing in some confidence back into the market, and not bringing some confidence in, bringing more confidence in.
Yeah,
right? A lot of people are feeling confident right now. But what we are starting to see, and we've already seen it, and I've talked about it, Darren, is we're seeing that huge increase in debt. And we're seeing that huge increase not only in what the federal government is creating in debt, but the huge increase in personal debt, especially credit cards.
Yeah.
And so what is the downfall of that is we are seeing a huge percent of refinances on FHA loans that are basically taking cash out. FHA is much more lenient, and they are basically giving up that 3% rate to go with the 6.5% rate so they can get cash out to pay out credit cards. So we're seeing a huge increase in FHA refinances. To me, that's the first and most important sign that we're starting to see people get in trouble. Now, when I mean get in trouble, I mean getting overwhelmed by this credit card debt, still making the mortgages. Okay.
Yep. Mm-hmm.
You and I both know we ran the numbers for short sales and foreclosures, and they were extremely, extremely low. But the more people that we see doing refis, and the more people we see trying to get, areas to pay off credit card debt, scares me tremendously. So it's not happening now, but it is the wheels are getting in motion that, the lending is going to start picking up on the cash out refis to get rid of this insurmountable credit card debt.
Yeah, I know it's definitely been becoming a problem more and more. We've been kind of tracking it for the last couple of years now. Like you said, you just didn't know at what point are people going to go ahead and start to do that and make that adjustment and use their home equity, if you will, with the amount that it's grown. The biggest thing, obviously, we need to pay attention to as agents is going in. And one of the first questions I ask, even in a phone interview, is, do you have a mortgage payment or a second on the house? And so I definitely know that we're going to start to see a lot more of that, and that's going to factor that in. Probably the hardest thing for sellers to realize is when you do a home equity line of credit and you take your equity in your home to pay off your credit card debt, that's fine. I think that's great. No problem at all. I think the best is plusectomy. Go ahead and cut them all up and don't use them as much as possible, if any. But the problem becomes, Terry, when we sell the house and all of a sudden, the 1 minute they've got 100 or 150, 200,000 or whatever dollars in equity. And then they use $50,000 to pay off their credit cards, whatever it is. And then you show them on the net sheet, when you sell today, you're going to walk out with $100,000 and they go, whoa, I thought I was going to have a lot more money. That's not that much money. I thought I was going to get more. Well, you've already used your equity in your home. Oh, that's right. We paid off our debt. Yeah. So my biggest thing is this. I hope that we don't see what we saw happen in the crash last time, that now people are underwater and they're selling and they're like, oh, wait a minute. I got to bring $5,000 or $10,000. I mean, I think we're still far from that to a degree. But can you imagine getting back to the days where people have to bring $5,000 or $10,000 or $25,000 to sell their house, and then they're mad and they're like, well, you've already used all your equity. You've used it like an ATM machine. So it's time that, your values are not going to continue to keep going up double digits a year, only to keep refining, only to keep using all that fake equity to be able to live a lifestyle that's outside of the ultimate means that you make as far as your income and such. That's the thing that concerns me if we continue to get back onto that path. That's all.
Yeah. And home equity lines of credit, basically, that's the number one thing that people are doing is they're draining equity. Number two is if they can't qualify for a home equity line of credit, they're going to take a look at that FHA refi and get cash out.
Yep.
The most lenient, you can have a lower credit score, because what happens is when you take out a credit card and you have a $20,000 balance on it, okay, a $20,000 credit limit on it, and you use it every month and you borrow 3 and pay off 3 and borrow 4 and pay off 4, and you kind of run money through it and your balance is never more than 30%, okay, your credit score is going to be outstanding. But what's happening is these people with outstanding credit scores are taking that credit limit and now they're still paying for vacations. I'm not going to not go on vacation with my family. Or through all the cuts that the government's had, a lot of people got so surprised that they didn't think they'd lose their job that they are saying, well, I got to live, I got to work on credit. So those credit limits of $20,000 are now being maxed out, right? When a credit card is maxed out, your credit score goes down. And when your credit scores goes down, it makes it very difficult to get a home equity line to pay it off. Once those credit cards are paid down and paid off, your credit score shoots back up like a rocket. But if you owe $20,000 on a $20,000 credit limit, you are going to have a low credit score. But Terry, I've made every single payment. I understand that. But you are at full capacity. That comes into play no matter what the credit limit is. Think about this. Who's going to have a better credit score? The guy that only knows $1,000 or the guy that owes $20,000? That's the question. Who's going to have the better? Everybody's going to tell me the answer is
the person that owes less.
Person that owes less.
So less risk.
That is wrong. If the person that owes less risk has a $1,000 credit limit, he's maxed out. If the person that owes $20,000 has a $30,000 credit limit, he's only at 66%. So the guy that owes the more money is going to have the better credit score. I know it's hard to comprehend, but a lot of it is dealing with credit limits, and that's something that you got to take a look at.
Definitely.
So be proactive, get ahead of the ball game, Stop trying to use these credit cards to keep the engine running. Figure something else out. Looking at a home equity loan, yes, you're going to drain value in your property, but it's going to keep you going, keep your head above, water.
Yeah.
So it's a tough time, and that's what we're starting to see is this credit card debt that 5 years ago it was at about $700 million. It's almost doubled.
Wow.
It's almost doubled. We're at 1.3 trillion right now in credit card
And
debt.
it just keeps climbing.
And at 24%, which is what the banks are charging, it's you're in trouble.
Yeah, it's crazy.
You're in trouble. So I didn't mean to go off.
No, that's
on that
good.
tangent, but
so
that's something
keep an
that
eye
we
on your credit.
really
Keep an eye on the score.
take a look at.
Yeah, I've had a lot of people lately that more so have been complaining about how low their credit score is. They're like, how is this happening? And I tell them, you need to don't use Credit Karma. You need to get a bona fide credit report from Experian, Equifax, or TransUnion, and probably Equifax is maybe the best. And you get a free one every year. And I said, you need to get one of those, and you really need to check that out. You need to see what lines of credit is open, what's been closed for you, what you have voluntarily closed, and how much limits that you have in different capacities. But at the end of the day, I have found, Terry, the people that have the highest credit, that have I am very fortunate. I think mine was like 810, 815 out of 850 or whatever. I mean, basically, when you have an 800 credit score and higher, you can walk into a bank and they're like, okay, how much credit in the loan do you want? Because they know that you've been pretty stellar with it overall. But I just have a mortgage payment. I have no car payments. I have no credit card revolving payments or nothing like that. I think the ultimate thing I've taught my boys is if you got one credit card to be able to say like rent a car or get a hotel room or things that you got to have them with, and you pay that off every month, or you just go buy $200 in gas a month or so. And if you have no revolving debt credit on it line, or you just have a very low balance, if you have like a $5,000 limit, but you're only carrying $100 or $200 balance, and then you're paying it off or whatever it is, your credit's going to go through the roof. It is going to go sky high because you're so far under that capacity. But I told my boys, if you go and spend a bunch of money and you jack that thing up and you get to like $400 or $4,500 and you're $500 away from the limit, and then you only make the monthly payment on it, oh, that's scary to those credit card companies, boys and girls. And that's, I think, what a lot of people do. Forget about the interest rate. You really got to think about how this affects your credit and your daily living and all those kind of things like that. So, and it is very difficult. It's not easy to live inside your means at all. But that's why saving is so important. So good stuff. All right, let's get right back into the next big thing. We're going to finalize this up today. We've been talking about this the last 2 weeks, and I've gotten a lot of great comments and people out there. Even my man Barry Weller and others have been texting me and saying, man, that was fun stuff you shared. And they love my title about the real home value, please stand up, Eminem. The real one. The reason why we say, why is it so hard to have the real home value stand up, Terry, is because you've got, as a seller, a number in your head. I love when I go on listings. I'm going on one today. It's like an $850,000 to $900,000 home somewhere. It's like this. The price is right. I'm like, okay, boys and girls, Mr. and Mrs. Jones, the first number's an 8. The next 2, let's work on that. The fun thing is this. I don't even know if I've ever gone on a listing appointment where I've asked the sellers, husband or wife or whoever's selling it, what number do you have in your brain before I got here that you expect to sell the home for? I've only had like 1 or 2 times where they look at me and they go, we don't know. And I'm like, wait a second, you don't know? So if I just pull a number out of the air, if I just simply say $200,000, you're good with that? You're going to trust me? And then they're like, whoa, that's crazy talk. Well, you didn't know. You said you have no idea. And so let's just pick a number. Let's just have fun with this game, right? And the bottom line is I proved very quickly you have a number in your head. Okay, so don't you be lying to anybody now, right? Come on. You have a number in your head. Every seller has an expectation. There's nothing wrong with that. I heard one real estate agent one time, Terry, say this on a podcast, and it was really good. He said, Mr. and Mrs. Jones, whatever number you got in your head, take 10% off that number. That's reality.
Really?
Yeah. I was like, I'm going to have to try that one day. Let's see if the real Slim Shady stands up with 10% less than what a seller thinks in their head, So there's nothing wrong with that. Everybody's got to have a number. It's good to know where's your starting point, what's your expectations, where's your head at. And I always like to know why you think that. Why do you think that way? Besides the fact that you own it, you love it more than anybody else. Is it because you just put a new roof on, you've done all these updates and you've updated it? Or is it just simply because it's your house and you've been in it for 20 years? Well, yeah, you're attached to it. That's a pretty significant time frame. Most people I find that, Terry, they live in their house like 2 or 3 years and want to sell it. They're not real emotional about it. They're just kind of like, there's a problem. There's a problem with a house that they don't want to fix. Or there's a problem. I had one this last year. I was surprised. They called me and said they wanted to sell it. I'm like, why? You've been there 2 years. What's wrong? You know what they said? The new neighbor.
Wow.
Yeah.
And you do not have to disclose the new neighbor.
No, you don't have to disclose the new neighbor.
But you do have to disclose a lot of other problems.
Yes, you do. If there's an issue with your house and property, we have to disclose it. It's called a no material fact, right?
Yeah.
Latent defect.
But neighbors does not fall into that.
Nope,
right?
Neighbors are not a latent defect. They are to you, but they may not to be somebody else. So, yeah, but I thought that was pretty hilarious. So we sold their house, and they were very happy to pack and go away. In fact, I think they sent like cookies and flowers to the wife and to the neighborhood as they were leaving. I guess I don't know. But
that's a shame.
It's a shame. It is a shame because you never know who's your neighbor. Even when you move in, you may meet them beforehand. I don't know, and it doesn't mean you know everything about them. And you surely don't know if the neighbor sells their house after you moved in, who's on the way. And you can't you can't dictate that at all. So, but I thought it was funny. But your home, like we talked about, the person in your family member standing up telling you a number, they're not going to be right. The appraiser, this, that, whatever, Zillow. When Zillow stands up with his estimate, they're probably not right. Realtor.com, Homes.com, Remax, and all of them we've talked about, and we've said this, Terry, that the truth is the buyers are the only ones who care about what it is, and that's the end of the story, because that 9 out of 10 times, that is going to be the market. And that can be crazy. You don't have to accept it. I tell sellers all the time, don't get offended of an offer that's low or this or that. Don't be offended. Don't get offended. Don't get all emotional. It's just business to them. That's all. They just, and they're like, they must not like our house. They may love it. They just don't see the value in it for whatever reason, But the facts is this, and I'm going to share this and go into the next segment of this, Terry. That's really important. Is the faster the seller thinks like a buyer, the more money they're going to make at the end of the day. That's the bottom line. And how is that? Because you become subjective mind setting, and now your logic is over your feelings and all of your emotions. Days on market is the enemy of your asking price. Okay. And as we know in the market we're in today, it's been growing a little bit. It's been stable and then growing and back down. And, we get back to that 30, 40-day average time on the market and all that. I would never recommend, because you don't want to be late to the game like the interest rate thing. I would always tell sellers, you don't want to wait till then. The bottom line is you want to make an adjustment if you've been priced too high. You want to make an adjustment before buyers wonder what's wrong with it. What is that lucky golden number? Probably about 10 days. You got about 10 good days before buyers' minds start to wander off and what's wrong with a house, Neverland, we call it. So 95% of the time, your first offer is your best offer. Don't play that game, because you're going to wish and hope we're going to get a better. No. If you get one offer, 9 out of 10 times, it's probably pretty good, especially in the very beginning of being marketed. Go ahead. Any thoughts?
Well, yeah,
I saw you crinkle over there, and I was like, he's got something going on.
Chuckle. I had a borrower that they fell in love with a house, fairly new on the market. They were the first to offer, but it had been some time before they put their offer in. And when they put the offer in, the realtor put it in for full price and asked for no closing cost help. And the other realtor, they countered at a higher price. And the realtor was like, what? And the listing agent said, well, this is the first offer we got. Yep. And we know that there's going to be more coming in. So we would like you to pay a higher price than the list price. And the buying realtor was like, are you kidding?
Yeah, right.
So when you said the first one
Yeah.
is usually your best offer, that's makes me chuckle because this agent had in his mind, and what I think happened was the agent promised a multiple bidding situation and
Yeah.
it didn't happen.
Yep.
So that's the listing agent was trying to save face, is what I feel happened. But so my borrowers came back and I said, listen, we'll give them an extra $2,000 if that's going to make the deal work.
Yep.
But when you said that the first offer is usually the best,
I love it.
that
Just
one
go
popped
above
into
the
my head.
price.
Yeah.
All right. Pricing a property is sure. Multiple offers 99% of the time. This works like a charm for the sellers. I have never promised a multiple offer situation unless we put your property on for $100 and it's worth about $500,000. That's when I can feel very comfortable about that. The big thing is seller's greatest fear. We talked about it a little bit before. You can tell me to give my house away. Nope. You're not giving it away unless you own nothing on the property and you are going to sign the deed over for nothing in return. Then you just gave it away. Outside of that, you're getting something. You're going to get something of value. And so there it is. And if I gave your house away, I wouldn't make anything at all either. So why would I do that, right? You're not going to be honest with me. That's a big fear sellers have. How do I know my agent's being honest with me? Well, we have this neat little thing called ethics, and we have to abide by those. And inside those ethics, Terry, is something that most sellers don't know about. As an agent, we have taken a vow and a pledge to not overprice your home, to not tell you something that is a blatant lie about the market and about pricing your house too high, knowing that is going to hurt you. It's going to help us because you're going to go, oh, good, I'm going to pick the agent who tells me the highest price. That is the dumbest strategy a seller can use to pick their agent. You want to pick somebody who is honest, ethical, knows the market, understands what's happening, can explain trends in data, and be able to help you get the best offer possible with the greatest marketing strategies in place. That is an incredible agent, and that's something I have tried to do every single day for 22 years. So it's unethical for an agent to tell you a price just to get the listing. That is crazy. That's the kind of agent you really want to run away from, because I promise you'll get less money later, or you'll be calling me second to find out the truth and all that stuff like that. So, and my favorite for disaster and crash and burn is let's just try the market.
No bueno.
No bueno. This is not a dating game. This is real life, real money, real lives, and legal stuff too, I may add. And again, days on the market is not your friend. All right, guys, take care. Hope you guys have a great day. This has helped you out. Have a happy Saturday and 4th of July. We hope you guys had a great time. Happy selling and buying from your Frederick Real Estate Update. We'll see you next Saturday. Take care now. All right, guys, take care. Have a great, great weekend.